Imagine a place where everything related to money is frozen in time for nearly 3 decades. Your salary doesn't budge, the price of your unagi bowl stays the same, and the interest rate on your home loan is closer to zero. Well, that was the reality here in Japan. We were used to seeing the price of everything remain pretty much the same, but it wasn't always this way. Since the end of World War II, Japan has been the epicenter of some of the biggest economic experiments. Now, the Bank of Japan has decided that it's time to end its latest experiment and move away from negative interest rates for the first time since 2007. The Bank of Japan, or BOJ, raised rates, marking the end of negative rates as well. So, how did Japan decide to manage its economy so differently from the rest of the world? And how will this massive change disrupt daily life across the country? Japanese growth wasn't always so stagnant. There was a time when the economy was growing so rapidly it seemed poised to surpass the United States as the world's largest. After post-war devastation, Japan achieved what was called the economic miracle from the 1960s to the 1970s. This growth was led by huge domestic demand, as middle-class households were expanding. By the late 1980s, the Japanese economy accounted for about 10% of the global economy. At that time, many had money to spare, and reckless spending was common. In the late 1980s, the stock market was booming, hitting record after record. Even crazier was the price of the real estate market. For example, the land price of the Tokyo Imperial Palace was equivalent to the price of the state of California. But then came the bursting of the bubble. In one of its most drastic moves, the BOJ sharply increased interest rates in 1989, trying to curb speculation and inflation. The government also introduced measures to cool down the real estate sector. The Nikkei stock price index halved, and real estate prices plummeted, leading the country into a prolonged recession. Authorities tried to slow down the economy, but instead, they froze it completely. People in Japan were not prepared for this. Living in a world without inflation makes people associate a certain product with a certain price. A small dose of inflation can boost economic growth by keeping money in circulation. Most economies aim for relatively mild inflation, around 2%. In 2013, the BOJ decided to take a drastic step again and introduce the policy of quantitative and qualitative easing, an unconventional measure where they essentially printed a lot of money and injected it into the market, aggressively buying Japanese government bonds. Initially, it was successful, but Japan faced deflation again a few years later. Then, the BOJ resorted to its tricks again and, in 2016, adopted negative interest rates, a move that divided economists. The main goal was to discourage saving and also to penalize banks that hoarded cash, but it didn't really work. In response, the BOJ came up with something called yield curve control, an attempt to control not just short-term rates but also long-term rates, so that businesses and households wouldn't have to worry about too much fluctuation in interest rates. This still didn't solve everything. Companies couldn't find sufficiently profitable ways to invest their money in Japan. Many ended up seeking opportunities abroad for better returns. So much so that Japan became the largest foreign holder of U.S. Treasury debt, suddenly surpassing China in 2022. But all this changed with the return of inflation. Japan finally hit its 2% inflation target. The problem was what drove it. First, there were higher energy costs due to the war in Ukraine, and second, a weaker yen. The Bank of Japan continued with easy monetary policy to stimulate the economy and even inflation. However, other major central banks raised rates to combat inflation. Eventually, it was external forces that led Japan to end its experiments. In other words, it wasn't the kind of inflation Japan wanted, because it wasn't coming from increased consumption. Wages remained low even as inflation hit 4.3% in January 2023, the fastest in decades, but it still weakened the yen, boosting profits for companies like Sony and Toyota, which sell products overseas. Finally, this brought some signs of change. Business leaders, who previously hesitated to raise wages for fear of having too many fixed costs, began to open up to raising wages. The main labor unions secured the biggest wage increases in 30 years. So, finally, on March 19, 2024, the BOJ took a big step. It ended negative interest rates, 17 years since the last increase. And now, what can we expect with the end of the negative interest rates experiment in Japan? Well, here are some of the changes we can expect to see. First, mortgages will become more expensive for the first time in decades, and the interest payments on the government's debt, which exceed $8 trillion, about twice the size of the country's economy, will increase. The same thing will happen with businesses. This could also boost the yen, which means your trips to Japan might become more expensive, and Japanese exports will also suffer. On the other hand, it could also make investing in Japan more profitable, as well as cheaper imports of fuel and food. Good news for Japanese consumers, but not so good for the foreign consumer of Japanese products.